There is a version of financial success that almost nobody talks about, and it is this: getting to a meaningful net worth and then quietly making a set of mistakes that erodes it, stalls it, or keeps it from ever becoming what it was supposed to. And the reason nobody talks about it is because the mistakes happen at a stage of the journey that looks from the outside like everything is going well. The income is real. The investments exist. The number on the screen is bigger than it has ever been. And that is exactly when a specific category of financial errors starts to show up. I have spent a lot of time looking at the behavioral patterns that show up specifically when someone's financial picture improves. And what I found is that wealth growth, ironically, introduces psychological traps that do not exist at lower levels of net worth. Traps built on overconfidence, identity shifts, social pressure, and a set of very human tendencies that the building phase kept in check. Today, we are going through all of them because the goal is not just to build a net worth, it is to actually keep it, grow it, and use it correctly. Let's get into it. Here is the framework I want to set up before we go mistake by mistake. In the early stages of building wealth, the constraints are mostly external. The income is limited. The margin is tight. The necessity of discipline is obvious. There is not much room for error because there is not much surplus to make errors with. The situation itself enforces good behavior. But as the net worth grows, the constraints loosen. There is more room, more options, more decisions to make. And that expanded decision space is exactly where a new category of mistakes lives. The research on this is clear. People with growing wealth face a decision complexity that lower net worth individuals simply do not encounter. Where to allocate, what to do with windfalls, how to respond to new social expectations, how to think about risk differently, whether to help family, whether to spend more. None of these decisions exist at the beginning. They all arrive together as the number climbs. And without a deliberate framework for navigating them, the same intelligence and work ethic that built the wealth can quietly start to undermine it. The first mistake is one of the most psychologically understandable ones on this list, which is exactly what makes it dangerous. When someone sees a meaningful net worth number for the first time, whether it is 100,000, 500,000, or a million, something shifts in how they relate to spending. The number creates a felt sense of abundance that is not always tied to actual liquid resources. And that felt abundance can loosen the discipline that built the number in the first place. Net worth includes illiquid assets, home equity that cannot be accessed without selling or borrowing, retirement accounts that come with penalties for early withdrawal, investment portfolios that might be down 20% the quarter you decide to access them. The actual spendable, accessible cash available is almost always a fraction of the total net worth number. Spending or making commitments based on the bigger number rather than the liquid reality is how people with genuinely impressive net worths find themselves in cash flow crises that make no sense to anyone looking at their balance sheet from the outside. This one is so common that I almost called it the arrival fallacy of personal finance. The arrival fallacy is a psychological concept describing the belief that reaching a certain goal will produce a permanent positive feeling. It does not. And in financial terms, it produces something more specific: the false sense that the behaviors responsible for reaching the milestone are no longer necessary now that the milestone exists. The savings rate drops because it feels less urgent. The automatic investments become optional because the portfolio already looks good. The budget disappears because it feels unnecessary at this level. And each of these relaxations is individually defensible, but collectively they represent something important. The compounding engine that was quietly doing most of the work has been switched off. And compounding, once interrupted, takes a long time to recover its full momentum. The net worth was not a finish line, it was a checkpoint. And the habits that got you to the checkpoint are the same habits required to go further.
There is a well-documented psychological phenomenon called the wealth effect, and one of its less discussed dimensions is what it does to investment confidence. When a portfolio has grown significantly, the person watching it tends to attribute that growth to their own skill, rather than to the market conditions, the time horizon, and the boring consistency of their strategy. And that attribution error, crediting yourself for something that was mostly mechanical, has real consequences for how you invest going forward. The research on individual investor behavior consistently shows that portfolio complexity and trading activity increase as assets grow, and that this increased activity almost universally reduces returns relative to a simple passive strategy. People start picking stocks. They concentrate in sectors they feel they understand. They try to time entries and exits. They hire active managers who charge fees that erode gains. Every one of these moves feels like sophisticated, intelligent investing. The data says otherwise. The boring strategy that built the portfolio was probably the best strategy for keeping it. At lower net worth levels, tax strategy is relatively simple. Standard deduction, maybe a retirement account contribution, not much else to think about. But as assets grow, as income diversifies, as investment accounts generate capital gains and dividends, as real estate enters the picture, the tax landscape becomes dramatically more complex. And the people who do not engage with that complexity early enough pay for it in ways that are both large and entirely avoidable. The gap between a tax-aware investor and a tax-oblivious one with identical gross returns compounds dramatically over decades. Asset location, which accounts hold which investments, matters. The timing of capital gains realizations matters. The structure of a business or side income matters. Charitable giving strategy matters. None of this requires illegal behavior. It requires engagement. And the mistake is not hiring a bad accountant. It is treating tax strategy as a once-a-year filing exercise rather than an ongoing, proactive part of wealth management. The people who understand this early keep significantly more of what they earn. There is a gravitational pull toward complexity that comes with the growing net worth, and I find it one of the most psychologically interesting patterns on this list. Part of it is social. Having multiple accounts and advisors and investment structures feels like what wealthy people do, so it becomes part of the identity performance of being financially successful. Part of it is practical. As situations grow more complex, more products and structures genuinely come into play. But a large part of it is simply the financial services industry doing what it is designed to do, which is to sell products and services to people who have money to spend on them. Every additional account is a thing to track. Every additional advisor is a fee to pay and a relationship to manage. Every additional investment product is a decision to make and a performance to monitor. Complexity multiplies not just the administrative burden, but the opportunity for things to fall through the cracks: an account forgotten, a fee unnoticed, a tax implication missed.
The most financially sophisticated people I have studied are not the ones with the most complex systems. They are the ones who have resisted complexity ruthlessly and kept an elegant, simple structure that scales without becoming unmanageable. This is the mistake nobody wants to talk about because it involves people we love. As soon as a person's financial success becomes visible to their immediate circle, a new kind of pressure begins. Family members who need help know where to look. Friends who are struggling feel more comfortable asking. And the person who just built something real faces a genuinely painful tension between the generosity they feel and the financial reality that their net worth is not a community fund. The data on informal family lending is consistent and uncomfortable. The majority of money lent to family members is never fully repaid, not because the people borrowing it are dishonest, but because the financial situations that created the need for the loan rarely resolve themselves cleanly enough to enable repayment. And beyond the money itself, these arrangements carry a relationship cost that financial calculations rarely include. The loan changes the dynamic. The unpaid balance sits between people. The person who gave quietly builds resentment. The person who received quietly builds shame. Nobody wins financially or relationally. The minimalist money rule here is this: only give what you are genuinely comfortable never seeing again, and only in the form of a gift rather than a loan. Frame it honestly. Give within your means without compromising your own trajectory. And build the emotional capacity to say no, clearly and kindly, when the request exceeds that. Protecting your financial progress is not selfishness. It is the prerequisite for being in a position to help anyone over a long period of time. One of the most psychologically reliable things that happens when someone achieves a meaningful financial milestone is that their reference group upgrades automatically. The person who spent years comparing themselves to people struggling financially now finds themselves comparing upward to people with larger portfolios, bigger houses, faster wealth accumulation. And the social comparison mechanism does not care that the new reference group is objectively wealthier. It just registers that you are below the new average. This is the hedonic treadmill applied to wealth milestones. 100,000 becomes the floor you no longer notice, and 500,000 becomes the goal. 500,000 becomes the floor, and 1 million becomes the goal. 1 million becomes unremarkable, and 10 million feels like what actually matters. The absolute number is irrelevant to the feeling, because the feeling is generated by comparison, not by the number itself. And comparison is infinitely scalable upward. There is always someone further along. The comparison never resolves, it just migrates. The antidote to this is one of the hardest things in personal finance: deciding what enough means before you get there, and then holding that definition even as the reference group changes. This requires grounding the wealth target in actual life goals. What does the number need to do for you, practically and concretely, rather than an abstract comparison to others? The people who manage this are the ones who reach genuine financial satisfaction. The people who do not will find that every milestone delivers a much shorter period of satisfaction than expected, and that the horizon keeps moving. There is a particular danger window in wealth building that I want to name specifically. It is the period immediately after a meaningful milestone is crossed: the first 100,000, the first 500,000, the first 1 million. These moments generate a euphoria that is both understandable and financially dangerous because the euphoria feels like confidence. And confidence, at a moment when the asset base is still relatively new and untested, can accelerate into a cluster of big, irreversible decisions that the portfolio is not yet stable enough to absorb. The most dangerous financial decisions are not necessarily the ones with the worst expected outcomes. They are the irreversible ones. Buying a home at the top of your budget locks in a cost structure for decades. Leaving a stable income to launch a business eliminates the compounding contribution that was doing significant work. Making a large angel investment concentrates a meaningful chunk of net worth in a single illiquid position. Each of these can work out, but made in a cluster in the emotional window after a milestone, they remove flexibility at exactly the moment when flexibility has the highest value. The rule: slow down in proportion to how big and irreversible the decision is. The bigger and less reversible, the longer the decision deserves to breathe. This mistake lives at the intersection of psychology and finance, and it is one that almost nobody talks about until it has already done its damage. As the net worth number climbs, it has a tendency to become load-bearing in the person's sense of self. Not consciously, not by design, but gradually the number becomes part of how they understand their value, their competence, their place in the world. And when that happens, the number stops being a financial metric and becomes an identity metric, which means any threat to the number is experienced as a threat to the self. The practical consequences of this are significant. A person whose identity is anchored to their net worth will make emotionally reactive investment decisions during downturns because the portfolio drop does not just feel like a financial loss, it feels like an existential one. They will work compulsively past the point where the work is financially necessary because stopping feels like losing part of who they are. They will struggle to enjoy the wealth they have built because the number is always the source of validation and there is always a higher number to chase. The financial goal was supposed to create freedom. Instead, it has created a new kind of captivity. The final mistake is the most foundational one, and it sits underneath every other mistake on this list. As the net worth grows, as the years of building accumulate, there is a tendency to begin treating the progress as permanent. The number exists. It has been there for a while. It has survived a dip or two. It feels stable. And that felt stability gradually erodes the vigilance that built it. The emergency fund gets deprioritized. The insurance gets reviewed less carefully. The estate plan gets delayed. The portfolio concentration gets ignored. The assumption, unconscious but powerful, is that what has been built will stay built. It will not stay built automatically. Wealth requires active protection that scales with its size. A larger portfolio has more to lose in a market event. A more complex financial picture has more exposure to tax changes. A business has legal and operational risk. A high-income lifestyle has more fixed costs that can become catastrophic if income disrupts. The defensive behaviors, the insurance review, the estate documents, the emergency buffer, the portfolio diversification, the tax strategy are not one-time tasks. They are ongoing maintenance on a system that is worth protecting precisely because it took so long to build. The mindset shift that the most financially durable people make is to treat wealth protection as the natural continuation of wealth building, not as a separate or lesser activity. Accumulation and preservation run on the same engine: intentionality, consistency, and the refusal to become complacent about something that genuinely matters. The net worth grew because someone paid attention. It stays because they keep paying attention, even when, especially when, everything looks fine. Here is the thing about all 10 of these mistakes. None of them are made by stupid people. None of them are made by people who did not work hard or did not care. They are made by people who got the first part right and then, understandably, relaxed their grip on the second part. Building a net worth is hard. That is the part everyone celebrates. Maintaining it, growing it, protecting it, and not letting the psychological weight of it quietly erode the behaviors that created it, that is the part nobody throws a party for. But it is just as important. So take the list, sit with it, not as a judgment of where you are, but as a map of where the landmines are for the next phase. Because the next phase is coming, and knowing what is waiting on the other side of each milestone is the closest thing to a genuine financial advantage that most people never get.